Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, retirement planning specialist and full-time fiduciary, Tony Walker. And I want to take you down memory lane just a little bit. You know, as we record this show in June of 2025, I have literally been on TV since the mid-90s. And it's kind of funny how things run. So back in the 90s, I had a show called Your Money Matters. That was on for roughly about 10 years, and we covered all kinds of topics back then, investments, insurance, etc. Then we moved over to network television here in Louisville, Kentucky. And for approximately 10 years, I was on network TV every Monday as their featured retirement planning specialist. In fact, that's where I met our own Aaron Orander. So after that gig, myself and Aaron checked out and started the Worry-Free Retirement Planning Show that you're watching today, which has been in existence now for nearly 12 years and recorded more than 570 episodes. Can't believe it's been that many, but what a great ride. Now, with that being said, we're starting a brand new format. We've been experimenting with this a little bit. It's more of a podcast format. And when we get into this format and moving forward, I want to explain why we're doing that. So let's go down memory lane just a little bit, all right? So basically, when I started the show, Your Money Matters, back then we had a total of 3 employees. That's it. And back then, I had just gotten out of the investment world. We were focusing more on insurance, tax planning, estate planning, and things like that, and really didn't have a lot of direction for savers. I knew I wanted to work with savers, but we didn't really have a platform built out. We were starting to work a lot with annuities. In fact, I started doing so much work with annuities. That's when some of my peers dubbed me as the annuity king because of our work there. But then, as we've grown and as we've served our mission of helping more and more savers, take a look at how many employees we have now at Tony Walker Financial. Now, here's where we're different than the rest of the financial herd. We have more employees not to go out and sell more business. We have more employees to service the business that comes in through me. So what happens is you've got the owner of the company with this experience on the front lines who's looking at the situation, sizing things up, and as you're about to find out over the next several months as we work through all of this, how valuable this staff is to Tony Walker Financial in servicing what is brought in through the front doors. It's a unique relationship, unlike anything out there. And you may have experienced that. You know, big firms out there, but they might have 10 advisors and 3 support staff. We have, besides myself, 3 other full-time fiduciaries and then 14 to 15 support staff at all time. Why? Because we want to make sure the service is top-notch. Now, since that time, and we're going to talk about this today, our investment philosophy, we've created something called the split IRA concept, which quite frankly is being emulated by much of the financial world. And this split IRA concept gives our saver clients something that most people don't have. That's use, flexibility, and control of their money. A very unique process we offer our saver clients so that they can enjoy this money before it's too late. So what I thought I would do today, we're going to introduce the other fiduciaries, and today the title of our show is literally Our Investment Philosophy at Tony Walker Financial with Your Money. So with us in the studios to explain our unique investment philosophy for savers, I have to my left on the far end there of the table there, my favorite nephew and financial fiduciary at Tony Walker Financial, Wes Walker. Good morning, Wes. And then to his right, my favorite son-in-law, Mr. Trey Juergens, and man, is Aaron and Derek knocking it out of the park with the technology. We might have to have a drum roll here. Do we have Miss Heather Hughes in our Bowling Green office via Zoom? Here we go, folks. Drum roll. Technology works. Good morning, Heather.
Good morning from Bowling Green.
Oh, it's so good to have you. And what I thought we would do, we're going to get into our investment philosophy for savers. But before we do that, because you've been with me now close to 20 years, Describe what we were doing back then, and just as I had just given up basically working in the investment world after 9/11, and kind of bring us fast forward to where we are today.
Well, as you just mentioned, the firm was really focusing on insurance, tax planning, estate planning, that type of thing. And then the fixed indexed annuities really started to take hold and uh, were becoming a presence in the market, and you really embraced that. I think, of course, you weren't in investments at that point because 9/11 hit, and you really felt uneasy about the market when all of that tragedy struck. But then we started kind of getting into income planning and really putting plans to paper and showing clients what they could do with their retirement income. And then we saw that there was really a need for some liquidity in those plans. That's when we really adopted using Vanguard as, our investment platform. We soon outgrew that, and, you're probably gonna get to that in just a moment, and then eventually in 2017, uh, moved to Charles Schwab, where we have just thrived.
Very good. And start over. And speaking of investment philosophy, I know Wes, you work very hard on this. You and Trey. Sometimes I think the market, I guess, let's say that the market of savers gets a little confused in terms of our philosophy on investments versus the big boys and the traditional way most people do brokerage. So if you would, before we get into our bullet points here, kind of explain what you've seen in terms of the difference between how we manage things and maybe how a typical money manager might manage.
Yeah, absolutely. So our firm is very focused on getting people their money in short order. So a lot of it has to do with if they're needing money now, if they're needing money in the future, and trying to match that sort of time horizon to their risk tolerance. So that's a lot of what we do. Just for instance, if somebody's going to withdraw from an account in the next 5 years, we're going to be very cautious with that money. If they've got a longer time horizon, we might take more risk. I think the traditional financial institution is not really planning things out like that. They're more so trying to create their most efficient portfolio possible and squeezing everyone they can into it.
Yeah. And same thing, Trey. I know you're meeting with a lot of people and you've been now here close to 8 years. What would you say in terms of our philosophy and even some of the savers who are, they might say they want to take some risk, but what would be, let's say, and we'll get into this again in more detail, but our growth philosophy maybe versus another money manager who says this is our growth philosophy? What does that look like?
Yeah, even our growth strategies, the equity exposure is a lot less than what you might see out there in something that's more aggressive with a real active money manager. And a lot of savers have been in the 401k their entire careers, maybe followed a 60-40 of equity and bond or 70-30, whatever it is. Then they come over to us and we introduce them to these different products and options that are not available in the 401k, lay them out, as Heather said, in these income plans, and it's really eye-opening.
So with that said, so Wes, again, what we're getting ready to go off these bullet points, why did we come up with these bullet points we're getting ready to feature?
Well, it's important to understand what you're getting into when you get in with a financial institution. What is their philosophy? What are they really doing? I think a lot of different advisors can kind of sell the sizzle of, oh, we know what's going on with markets. We know which way they're going to turn. This document is almost just to say, we have no idea what investments will do generally. All we can do is sort of understand your situation to the best of our ability and then design an income plan for you and then invest your money accordingly. But we're not putting you into 70% equities because we think the equities are going to outperform.
Yeah, speak to that. And by the way, I'm very proud of Wes. I meant to mention this. Wes, and you all know how difficult this exam is, recently passed his Chartered Financial Analyst exam. So you are officially able to use that CFA. So I don't know, Aaron and Darren, could y'all find some crowd noise somewhere to give him a round of applause?
I'll take it, even if it's simulated crowd noise.
But no, congratulations on that. But again, folks, we are committed to the investment world, but we just look at it a lot differently. So let's kind of dive in. And I love this document that all three of you all worked on, but we give this to everybody now if they're considering working with us. And also, Trey, I know when you deliver those binders, or Heather, you are going over this with them just to remind them what our role is. So let's take the first bullet point, and Aaron, you might even want to put all this up in full screen as we're going. The investment platform of Schwab and how we use that with annuities. And I think if you don't mind, I'm going to let Heather weigh in on this. We call this our split IRA concept. Why is this so unique to the industry, and why does this allow us to give our saver clients so much flexibility in retirement?
Well, the split IRA concept is just a really efficient way to deploy money during retirement. The front end is the our Schwab bucket for what we refer to. That's our liquidity bucket. So initial income comes out of that. What that does is twofold. One, clients have access to income that they need. And two, it allows us to have the annuity grow and gain some steam over time. Time is on your side with an annuity. Then when we've had enough time elapse, we turn on the lifetime income from the annuity in most situations. So it's really powerful that we've got a platform in which we can handle income needs now and lifetime income later.
Very good. And Trey, it was funny. I had a couple in yesterday and they said, well, watch that show on the other day. I think y'all may even got a calls on this too, where I was comparing yields to payout rates. Explain why we're using MIGAs, multi-year guaranteed annuities, and how that works even with our mailbox money and maybe the difference there. So how yields have been up and that's really benefited us with these particular products.
Yeah, our clients come to us at different times. Sometimes interest rates are in a higher interest rate environment, sometimes lower. And we utilize different products for different reasons. And this client was really impressed by these yields on the fixed annuities you were showing on the whiteboard. She did not have one because she became a client in 2021 when interest rates were nowhere to be found. So she was like, well, Tony told me I should have this type of an annuity. I said, ma'am, no, you have this type of annuity. We want guaranteed lifetime income. And that's a lot of what savers do. They come to us, they go through the process. We identify the needs based on what they tell us. So by finding the correct products, a lot of times people are, why am I not all in Schwab? Why am I not all in annuities? We use a blend of both to kind of identify what they told us they need, and we can satisfy what they need with that income plan.
And we'll speak to that because and it actually has cost us money, quite frankly. If we use an example of 100,000, say we have a Schwab, and let's say for whatever reason the bond portfolio hasn't done well, and maybe somebody's wanting a higher yield. Now we have these MIGAs, and we move the 100,000 out of Schwab to a MIGA. Well, roughly, if we just take 1% as an example, that's $1,000 a year that's off our statement that we don't get in terms of fees. The MIGAs may be paying 2 and 2.5%. It's actually costing us money. But as fiduciaries, why do we do that? Why are we constantly looking out for the client? And as Trey said, depending on what products are doing, because they ebb and flow, our job to find those products that are suited for them at that time.
Well, I think the beauty of our firm is that we're somewhat agnostic in when we select investments. I think we're okay if it's a fixed annuity, a MIGA contract. We're okay if we're going to put money into Schwab or an income annuity, and we don't show this sort of bias toward one product or another, particularly if they're paying a high commission. That is pretty rampant in the industry, that if something's paying well, you might push it more. There's an incentive to do so. So our agnostic approach to picking investments is, I think, a boon to our business.
Can you Google Trey agnostic for me? I mean, no, very good. Good stuff. I love it. That CFA stuff's paying off, as Dick Walker would say.
Yeah. Teach me more words.
Good stuff. All right, let's go to the next one. That was good, though. Actually, I like that. Okay, now the Charles Schwab and the goals that we have for the Schwab and what it is not. Heather, speak to this very briefly. Gosh, we're having people, and quite frankly, we probably did more of this in the past before we had Schwab, but speak to the fact of how many people come in here loaded up with annuities and they don't have liquidity. Explain liquidity in layman's terms and why that Schwab bucket is so important for liquidity purposes in retirement.
Oh, sure. So with annuities, well, for most annuities, they do have restrictions on how much money you can take out. And typically, for a typical fixed indexed annuity, that's 10% per year. Sometimes clients need more money than that. And so to have that extra account that doesn't have any limitation on how much you can take out is very powerful. We often see clients that, especially initially in retirement, they want to possibly pay off their mortgage or they're in need of a new vehicle or, life happens. So to have some contingency money freely available to them is very powerful and has been just a game changer, I think, for us with our retirement practice.
Yeah, I would say we're always talking about my late great father and the Dick Walkerisms of the world. He used to always say nothing stays the same, meaning everything changes. I think to me that's one of the greatest truisms in retirement. I mean, you all are on the front lines. How many times, even when we have a plan laid out, have people's plans changed? And so that's the point, folks. You never know when you're going to need money. So again, split IRA. If you don't have something like that, we'd love to show you how that works. Let's keep going. Wes, I know you get this a lot. people think that Charles Schwab is the annuities. And we like to use this example of a supermarket. Explain our relationship with Charles Schwab, because we are not employed by Schwab. We make this clear. They're a custodian. We don't work for the companies. A lot of advisors technically work for these companies. We don't. So how do we explain to clients our relationship with Charles Schwab moving forward?
Sure. So Charles Schwab is a custodian. They hold assets for us. We work for our clients. Our only sort of obligation is just to serving our clients. It's not to serving any, sort of financial institution. But Schwab acts as almost a big grocery store, if you can kind of picture it like that. And we're kind of the nutrition specialist who's working on behalf of the client. So we're going to, to continue the analogy, design a meal plan by picking investments for them, go into the grocery store and determine what low-cost items can we buy that best fit their plan. To relate it to the analogy even more, if you were really on a health kick, you might stay around the outside of the grocery store, getting meats, vegetables, fruits, that sort of thing. You would probably stay away from the inside of the grocery store, the middle aisles where there's all sorts of sweets. And in this analogy, that would be very high expense mutual funds and all sorts of products they don't need. So we can pick those out for them using Charles Schwab.
It's funny, I overheard Derek ask Aaron, why would you ever go around the outside aisles? I think he heads right for the Lucky Charms, apparently, when he goes to the grocery.
There's some sweet stuff in there. I get it.
And Trey, would you like to add to that in terms of also our nutrition idea and how we set up these meal plans? I think that's a good one. I like that.
I'm getting hungry now. But no, I think that's exactly it. The Schwab provides us an opportunity to go and get the stocks, bonds, mutual funds that they're used to within that 401k. So if someone has a little bit of an appetite, if you will, for investing, we can certainly do that.
We can move over to the middle aisle,
exactly,
right?
Yeah. So we've been known, you're the annuity king, as they like to call you. So a lot of the times, that Tony Walker Financial, all they're going to do is stick in an annuity, and that's far from the truth.
And let's speak to that. So back to you, Wes. Roughly how much do we have now with Charles Schwab under management? Do you know that number right offhand?
Yeah, the AUM at last tick yesterday was roughly $340 million of assets under management. Now we've got more assets that we've written through annuity contracts, but still $340 million is not a small number.
And so, yeah, we can't call it assets under management. With our new CRM, Heather, I don't know if you're aware of this. Remember, I think TJ got nervous because I stumbled into a report that he said, you're not supposed to be in that part of I think they're worried I'm going to crash the software. But we have under our guys, we'll put it this way, including annuities, over $1 billion. You were aware of that number, weren't you? I think that's pretty incredible.
Oh, I was. And I was also a little nervous when you found that report. So, yeah.
Me and technology don't get along, folks. But with that said, and we talk about this in our Thursday morning meetings, we have all this AUM, but that doesn't drive us. I mean, how much more AUM would we have, Trey, if we really did not encourage people to use and enjoy their money? I mean, really, how much do you think we could have?
Drastically more. And that it is all part of the messaging, the live well, die broke philosophy, using and enjoying your money. The financial world doesn't really work that way. They want to charge fees on that money. If you need a new car, if you want to pay off the house, a lot of advisors are going to talk you out of that because they want to keep that money in the account. And we see it all the time that someone comes to us with these goals in mind and their previous advisor was poo-pooing that whole idea.
That's right.
And we give them the opportunity and the tax advice on how to do it. We pull that off and they become our happy clients.
Very good. And remind me, one of the things we're trying to do, folks, is start a monthly series. So this is all investment philosophy. Next week, I think we're going to talk about, let me see here real quick. I think we're going to talk about the responsibilities of Tony Walker Financial with the management. So that'll be our topic next week. But I think we could do a whole month on cash flow. What is the purpose of cash flow? So just like that, why would, a broker might say who's not trained in the art of retirement planning, why in the heck would you pull money out to pay off your home? Well, it gets back to cash flow. Some people don't want the obligation of the debt. So make a note of that, Trey, because that's probably something we ought to cover. All right, let's keep going. I love these analogies. And again, folks, this is what we have. I guess we could provide this as a download, couldn't we? Is there any reason we can't provide this document as a download?
Yeah, it's available on the website.
Okay, how would they go about finding this, Trey, if they want to see this document?
It's TonyWalkerFinancial.com. We've got the free downloads on the website.
Where do they click on that? Maybe we'll have Aaron, maybe you can go in there and show them on the website.
Yeah, the top right, if you go and you just find the downloads page, just your name and email, that opens up any of our free downloads.
Okay, awesome. I would encourage you to get this, folks. And again, we're trying to explain, we're just now joining us, the difference in the philosophy between Tony Walker Financial and the rest of the financial world. And I might make this mention, we're working with savers. I think that's the other thing. Even our friendly competitors, they don't understand. We're not working for investors and speculators. So these saver clients, whom we know very well, there's a certain thing they need and want, and that's what we're trying to deliver for them. All right, let's get down to this. We have two factors when we're choosing investments, and we'll just go around the horn here and anybody wants to jump in, but we call it risk tolerance and time horizon. So why is it so important, Heather, to talk about risk tolerance with people? And back to Wes's supermarket analogy in the nutrition, how everybody's different in terms of their level of risk and why that's so important to know up front.
Absolutely. So, a lot of times when I'm meeting with clients, I'm in front of them trying to choose what portfolio we're going to invest them in. And I always tell them there's no wrong answer to this. It's where your comfort level lies. Uh, the nice thing about our income plans is we do make lower assumptions on risks, on rates of return. And so I'm comfortable with them choosing any portfolio because I know the assumptions we've made on the plan, we should be able to maintain those for the most part. So we really, if it outperforms our estimation, then, we're in just better shape. And that way we can deal with certainties on the plan. So, it's really comfort level. A lot of times I'll ask a client, it's like, okay, if you see a drop of $2,000 in your account on your monthly statement, what's your reaction? Some clients are going to say, well, the market goes up and down. And some will say, I'm going to lose sleep over that. That's really our indication on where they need to be.
Yeah, Wes, speak to that because we just had a client in yesterday, nice gentleman, been a client for years, just retired, and he was talking about the Schwab portfolio. It's done pretty well, but what were his comments about it going up and down? Did you sense that he just didn't like the thought of that thing going up and down, and how did we respond to that?
Yeah, it gets right back to the same two items, risk tolerance and time horizon. So someone may even have a long time horizon. They might have 10 years. And the financial world traditionally would say you need to be 100% in equities with a 10-year time horizon. That is the most appropriate investment for you.
Because just based on time horizon,
Exactly.
right? Yeah.
But they don't realize that this person, if they see a 20% drawdown, will cut bait, run, and then make that loss realized. So again, even though they have a 10-year time horizon, if they have a low risk tolerance, that person at our firm might end up in a 10-year fixed annuity with zero risk. But it's all about knowing that client specifically and their goals.
And Trey, we just ran into this with a gentleman. He approached us. He's basically truly retired. And this guy's an investor. He admitted it. He said, Tony, if I tell you what, I am so tired of fooling the investment world, and I don't think he thought I could do this. And again, folks, we're filming this in June of 2025. These rates change all the time, but this was the other day. He said, I don't know. I was just thinking if I could get 5% guaranteed for the next 5-10 years, I don't know, we can do some business. And I said, are you serious? And he goes, yeah, I'm serious. I said, well, let's do business. He said, what are you talking about? Because he knew in the market I couldn't guarantee that. But with the fixed interest annuities, we could. And back to your point, Wes, from a time horizon standpoint, it didn't matter. He was truly an investor, but he was at that point in his life, he just didn't want to take any risk, and 5% was fine. So speak to that. You see a lot of clients, the same thing Wes is talking about, and maybe a broker doesn't understand this whole concept that they just don't like taking a lot of risk.
Yeah, a lot of the time, the financial entertainers out there saying that, well, if you're in the market, you're going to get 8, 10, 12% every year. Yes, the S&P may do that over time, but if you have the appetite to be 100% in the S&P index going into retirement, you're probably not a client of Tony Walker Financial. So if that's what you're looking for versus a plan to use and enjoy your money without the fear of running out, go have fun. But if you're looking for a plan where you're not going to run out of money, that's where we come in.
I was going to say, are you online there, Wes? Can you see what the S&P did? Was it 2022? We had a little drop. I think it was 20. Yeah, we use an example. As we were looking that up, Wes. So I think speak to the fact, Heather, that also in retirement planning, it's a totally different world. When you're drawing money out, I know the fancy schmancy word is sequencing of returns, but for a layman to understand that, why is it so important that if you don't have to take the risk and don't have an appetite for it, what happens if you do continue to take risks? Now, all of a sudden, you're taking money out of that in retirement.
That's always a scary prospect. And of course, we've seen a lot of market volatility, the last several months, especially. And if you're drawing significant amounts down and the market is falling, it has a devastating impact on your overall plan in the future because your assets are just no longer there, and it's gonna be much harder to regain those losses as you're drawing that down. So it's really important for us to be strategic on where you're invested, 1, and then 2, where we take your money from. So oftentimes we may feel like we need to switch that up a little bit or adjust things. But the nice thing is that we do try to meet everybody's income goals as far as their assets allow. I mean, it's really difficult, if the market drops 30% and then we call them and say, "Hey, maybe you need to just take 30% less from what you're normally withdrawing." And most people can't sustain that on, their monthly budget.
What'd you come up with, Wes?
Well, here's what I would say. So looking back in these returns, I just kind of looked at the most recent history. In 2019, this is the S&P 500. So this is a major market index. It's not one of our portfolios, but 2019, it did 31%, 2020, 18%, 21, 28%. But then in 2022, there's a negative 18% return. And then in the following years, there's double-digit returns in 2023 and 2024. But let's just say somebody entered retirement, just happened to be at the end of 2021. They said, okay, I'm going to stick it all in the S&P. If that person is not suited for that level of risk, they may have very well suffered an 18% loss, sold at the bottom, gotten out to then something that's fixed, and really cemented those losses. So I think that the key is to know your client personally, know what they'll be able to withstand, and then put them into a plan that makes sense. If you're just tossing money at stock indexes and you don't know what you're doing, don't know yourself and your way of your risk tolerance, it can get real messy real quick. All right, you're watching the Worry-Free Retirement. Don't forget, the full-length episode of this interview, which lasts another 10 to 15 minutes, is on YouTube. You can check out all of our YouTube videos, youtube.com/Tony Walker Financial. We'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Welcome back to the extended interview that we have, the investment philosophy of Tony Walker Financial with your money. And again, we're talking about how we are so unique in working with savers. This is, by the way, this is a download you can get, folks, at TonyWalkerFinancial.com. We're covering, what did we end up calling this? Just understanding the Charles Schwab platform. So in case you're just now joining us, a lot of people think we're affiliated or, quote, associated with Charles Schwab. As we explained earlier, Charles Schwab's like a grocery store. Their job is to bring all the produce and all the products there. We go shop for you. We bring it back. We implement everything. We check your diet out, your nutrition. We do it all for a flat fee. By the way, our fees are clearly disclosed. If you want to see our fee structure, again, it's at TonyWalkerFinancial.com. You can see what we charge to manage these Schwab platforms. But there's a myth out there, I think, that people can actually predict markets. We've talked about that. And there are people that I think are very good active investors. I'm not downplaying that at all. There's people that have that skill. I would argue they're few and far between. But I'm going to start with you, Wes. There's a difference between active and passive. First of all, define active, define passive, and then where do we fall in that definition? Sure. So an active investor is someone who deviates from a major market index. And that sounds like a bunch of gobbledygook, but a major market index is like the S&P 500. So an active manager would take different positions than what the S&P 500 holds. They might overweight a certain company like Apple or Amazon and underweight other companies like, Microsoft or Tesla or something. So they would make these active decisions. A passive manager is someone who really just buys the index in whole and holds it for a foreseeable period of time. It's not so much about making active decisions, but rather just exposure to the stock market over a broad period of time. At Tony Walker Financial, we design our own portfolios. For the large part, they are made up of passive indexes. There's a couple portfolios that have individual stocks, but they make up a small percentage of that. Really, we're just gaining exposure to the stock market and then passing that on to clients.
Let me ask you this. Included in that active, would you say market timing, and is that a big part? Because we're not really trying to time the market. Would that fall into passive versus active? How would you classify market timing, so to speak?
It's very dependent. So there's all sorts of different financial products out there. There are active mutual funds that stay 100% invested in the stock market at all times. These are probably my least favorite of any active product. They charge a very high expense ratio. You might pay 1% a year to these active managers. You never get to talk to the active manager, but you're giving them 1% of your money each year. And then there are other people like Warren Buffett who would try to find a company with a durable competitive advantage and then buy it below its intrinsic value for his shareholders. That's a lot different. I think that style of active management, where you really are sort of understanding an individual business and then buying it for long term, can probably work pretty well if you know what you're doing. But these active managers who run a lot of these active mutual funds largely underperform the market generally.
Again, Wes, really good definition of those two. So how does that parlay in, Trey, as you're meeting with more and more clients, even in the binder delivery process, somebody has become a client, where do we have to remind them of our role moving forward in this passive strategy, and that we mainly are retirement specialists with the investments supporting the retirement plan?
Yeah, usually it's making sure you get it right on the front end. We want to really communicate to them what we're looking to do with this Schwab account, where we fit in, where Schwab fits in. And when we put them in a strategy, it may align with the fact that they're going to be taking this money out over the next few years before they ever decide to kick in the annuity. But really, it's just better allowing them to understand where we fit in and where Schwab fits in, knowing that it's not this actively managed strategy where we're going to jump into the market, jump into cash, and really try to time the market. That is not at all what we're looking to do.
And I think one of our commitments too, I think we are some of the lowest fee industry folks in the country in terms of all of the services. So first of all, Trey, make sure people understand all of the services we offer, and we'll just use a flat fee of 1%. It's different than that, and I would encourage you to go to the schedule online, because the more money you have, obviously the fee gets less. But explain our role, all the services, and then what we found, and I want Heather to comment on this as well, what is the average advisor out there really doing with the investments that is not what we're doing, obviously?
Yeah. Well, as you always say, this whole world is OPM. It runs on other people's money, and everybody has to get paid. We are very cost conscious. So by using Schwab, which is notoriously low cost, by using funds within our strategies that are low cost, keeping our fees what we think are very reasonable for all the services, tax planning services, income planning services, the access they have to us as the fiduciaries, we feel like our fees are very, very fair. There's this new model, not necessarily new, it's been around since the 80s, but with these turnkey asset management programs and platforms, advisors who may be the client-facing advisor have really nothing to do with managing this money. But by doing that, they're passing on additional cost to the client. And we're seeing these upwards of 1% being charged by your advisor, and then additionally, these other asset managers making almost just as much. These fees could be as much as 2%.
Yeah, and speak to that, Heather. I know you were at a conference recently, and I think you were a little bit in shock as you got to meet, there was a lot of advisors there, great advisors and all that good stuff, but when it got to this money management side, as they like to call it, and what they were managing, what did you find out from most of these advisors?
Oh, yeah, that was pretty funny. I found out that they weren't managing. So, as Trey mentioned, they're hiring an asset manager, which is that cost is passed on to the client. And I came away with, well, what do you even really do? So, and they were equally as shocked that we develop our own portfolios and we do all of our trading. They're like, "Oh, you do that?" And it's, yeah, that's kind of our responsibility, we feel. And we do look for lower cost investments, and we have an investment committee that uh, meets quarterly, if not even in between there, to discuss the portfolios. Of course, um, Wes has done an amazing job trying to keep track of all of that as well. But yeah, we do have a hands-on approach to investment and what we're putting our clients into, and understanding those investments as well.
And we'll close this out. This has been a great program. I kind of want to close it out with you, Wes, dovetailing on what Heather said. I mean, our job is to provide very quick, be very nimble, get that money back to clients when they need it. Why is it so important that we're doing all the trading And you know me, when somebody wants something done, if a client says that, I want it done lickety split, as I like to say. So describe how quickly we can move. Let's say if somebody calls out of the blue and go, I need $30,000 right away. What do we do to spring into action to get that money to them?
That may be a longer process at other places to get money to clients. I think the good thing about us is you're going to call in directly to the office. You're going to talk with someone that you've likely talked with before in the past. They're going to set that up for you. They're going to make sure you don't throw yourself into a higher tax bracket by taking that sort of distribution. And there's all sorts of other planning that goes into things like that. Jumping back a little bit, I mentioned those actively managed mutual funds. Aside from advisors or anybody else getting in the mix, just to manage the assets inside of those mutual funds, they're charging 1% a year. Some of them.
Just the assets, that's all they're
doing. Won't
doing.
name any names, but just to pick stocks, they're charging 1% a year. With our fees, if they're around 1%, you're paying us the same amount, but you're talking to someone that you know every time you need money. You're talking about your investment mix, your income plan. There's a lot more detailed planning for essentially the same cost as paying someone in New York to sit around and think that they can pick stocks. So I think there's a lot of value added at Tony Walker Financial.
And speaking of that, we'll close with this, because one of the things, folks, I'm meeting 20 to 30 people a week. You all are talking to all kinds of people that are clients each week. We get to hear the feedback of the clients. When we remember, Heather, we used to do focus groups, and I said, well, that's a waste of money. We'll just talk to our clients. We have so many clients. But a gentleman was in yesterday, and he said, and you met him, Trey. He said, I'm going to do business with you. And I asked him, I said, why? I knew he was shopping around. He said, well, I won't name the big boys. He said, a buddy of mine said, you need to be working with so-and-so. And he said, well, I want somebody local that I can sit down and talk to, and they can't provide that. And that was so important to him. And I think, like you said, moving forward, and I would encourage people to think about that. As you get older, think about this, folks, or you lose a spouse. Do you really want to be calling these 1-800 numbers or going in these firms where there's constantly a revolving door? I would think, if it were me, I know I am, I'd rather go talk to somebody face-to-face that I know. So in conclusion, folks, if that's you, maybe you don't feel like you got any personal service out there, you're looking for an advisor you can trust, give us an opportunity to talk. Why don't you just log on right now to TonyWalkerFinancial.com, set up a free, what we call fiduciary phone call. We'll talk about your situation, and if it merits, we'll be happy to meet with you in person. No obligation, and that is absolutely free. Again, it's TonyWalkerFinancial.com, or call us anytime, 877-499-9255. Well, folks, next week, make sure I'm correct on this, Trey. So next week, for those of you who want to continue to follow this, we're actually going to continue with this document, but technically this will be entitled The Responsibilities of Tony Walker Financial. And this is going to be a good one for people, because I don't think people know what the responsibilities of a financial advisor are. So we're going to be very forthright and tell you what you can expect if you do work with Tony Walker Financial. So Wes, Trey, Heather, thank you so much for your time. And folks, we'll see you soon.